How to short a stock. Selling shares of a firm that you don't actually own in the hopes that the stock price will decline. Stop to repurchase the shares at a discount. Keep the difference as profit. Here is an example of shorting a stock. Let's imagine you think the XYZ company's stock is overpriced at $100 per share and that you anticipate it to fall to $80 per share soon. Selling 100 shares of XYZ company for $10,000, or $100 per share, is your choice to short the stock. You can sell back the 100 shares for a total of $8,000 and make a profit of $2,000, $10,000, $8,000, if the stock price falls to $80 per share. However, if the share price increases to $120, you would have to pay $12,000 to buy back the 100 shares, which would result in a $2,000 loss, $12,000, $10,000. Let's now discuss how to short a stock using options. The right to buy or sell a stock at a specific price, known as the striking price, known as the expiration date, is provided by options contracts, although it is not a legal requirement. Without really shorting a stock, one can use options to profit from a fall in price. How do you borrow a stock for short sell? You must have a margin account with your broker in order to borrow a stock for short selling. The steps are as follows. Choose the stock you want to sell short. Make sure your broker has shares available for borrowing before choosing the stock you wish to short sell. Put in a short sell order. Tell your broker to put in a short sell order. This is selling the stock at the going rate with the hope of later being able to repurchase it for a higher price and profit from the difference. Borrow the shares. Usually using a procedure known as securities lending, your broker will identify the shares for you to borrow from another investor's account. Pay interest. For the duration that you retain the short position, interest will be due on the borrowed shares. Depending on the stock and if shares are available for borrowing, the interest rate changes. Finish the short position. You must buy the shares back on the market and provide them to the lender in order to finish the short transaction. You will earn from the difference between the sale price and the buyback price if the stock price has declined. You will experience a loss on the difference if the stock price increased. How to short a stock in Robinhood. Robinhood requires that you have a margin account with the brokerage in order to short a stock. The steps are as follows. Choose the stock you want to sell short. Make sure that Robinhood has shares of the stock you wish to short sell accessible for borrowing. Enable margin trading. You must enable margin trading in your account in order to access short selling. To do this, open the Robinhood app and navigate to the Account tab. Then, hit Settings and choose Investing. After that, toggle Margin Investing on. Place a short sell order. After the Robinhood app has been updated to support margin trading, place a short sell order by heading to the Stocks page, selecting Trade and then selecting Sell. Select Sell Short as the order type, then enter the quantity of shares you wish to sell short. Verify order details. Check the order details to make sure everything is proper. This includes the order type, the amount of shares to be sold short, and the current market price. Watch your position. Keep a watch on the price of the stock and any news that might have an impact on how the stock performs. You might want to think about cutting your losses by closing your short position if the stock price increases noticeably. Remember that using options to profit from a drop in stock price or shorting a stock includes major risk and ought to only be done by knowledgeable investors who have a firm grasp of the markets. Before making any investing decisions, it's crucial to conduct your own research and speak with a financial expert.